One thing that both potential and seasoned real estate investors can all agree on is that it's absolutely critical to understand the tremendous value that depreciation gives you as the owner of real property. When coupled with a cost segregation study, the benefit of bonus depreciation can get you close to eliminating your tax liability almost completely. Hi, it's David Weiner, Mr. Cashflow, and if you're new to the channel, welcome. Please take a moment to give me a big thumbs up on this video if it's helpful to you, and hit the subscribe button for more videos on commercial and investment real estate, as well as cash flow for your business. Stay with me to the end of this video because I have a special free offer that you're not going to want to miss. First, let's talk about cost segregation. Understanding that everything goes down in value, the IRS tax law says that property must be depreciated. Commercial property is depreciated at 39 years, and rental residential property is depreciated at 27.5 years. Let's look at an example using residential property, a multifamily purchase. On a $9.25 million multifamily purchase with a 15% land allocation, the depreciable basis is just over $7,862,000. Using the standard allowable straight line 27.5-year depreciation, the result is just under $286,000 depreciation every year. However, if it's done correctly, the IRS offers a tax planning technique called cost segregation that can accurately accelerate the property's assets into depreciable categories. This allows you to separate items that depreciate much quicker, minus the land, into 5, 7, 15, and 27.5-year depreciation categories on all multifamily assets. Using the same figures above, let's look at what impact cost segregation has on depreciation value. On that very same purchase with the same land allocation, a cost segregation study allows you to classify the property into different depreciation categories, which almost doubles the depreciation deduction for the current year and gives the owner an increase in cash flow over $105,000. Pretty good, huh? Just wait for the goose that laid the golden egg. In order to take advantage of cost segregation, you must hire a cost segregation specialist to conduct an inventory of everything on the property in order to determine what fits into each depreciable life category. The cost segregation specialist will carefully document every item and reclassify the personal property expenditures from the real property expenditures, which will result in lower taxes. Ultimately, the ROI is based primarily on the cash flow an investment creates. When you front load the depreciation, the time value of money or internal rate of return is greatly increased. Right along with it, let's look at bonus depreciation. The Tax Cuts and Jobs Act of 2017 made bonus depreciation, or what I like to call the goose that laid the golden egg, possible. Bonus depreciation used to only be available for new developments, but now it can be used for any new purchase as well. Bonus depreciation currently allows 100% depreciation in the very first year of acquisition for anything with a useful life under 20 years. The primary benefit of this is being able to accelerate the depreciation and create significant non-cash deductions. Let's look at that same property acquisition using bonus depreciation. With all the 5 and 15-year property depreciated 100% in the first year, the cash flow increase is over $700,000 in the first year. One caveat is that cost segregation and bonus depreciation can only be used for income-producing purchases and does not apply to your personal residence. They apply to all real estate owners that pay taxes, including individuals, estates, trusts that pay taxes, corporations, partnerships, limited liability companies. All are eligible for cost segregation. The golden egg is if you and your spouse qualify as an active real estate professional. To qualify, you have to meet 2 IRS requirements. 1, more than half of the personal services that you performed in all trades or businesses during the tax year must have been performed in real property trades or businesses in which you materially participated. And number 2, you performed more than 750 hours of services in real estate during the tax year in real property trades or businesses in which you materially participated. This includes any property, whether it's developed or redeveloped, constructed or reconstructed, and whether you acquire the property, convert it, rent it, lease it, operate it, manage it, or broker the property. If you qualify as an active real estate professional, all active real estate losses, including depreciation losses, can offset all active and passive income. You must qualify every year. If you or your spouse are unable to qualify by meeting both of those requirements listed, you'll be considered a passive real estate investor. In this case, your real estate losses, including depreciation, can only offset passive investment activity income. While that's not ideal, it's definitely better than not having the benefit at all, since any passive losses can be brought forward to subsequent years. Let's talk about 4 best practices for investors. With a better understanding of the benefits of bonus depreciation and of cost segregation, here are the 4 best practices that I recommend for investors. Number 1, be sure to use the estimated analysis provided by your cost segregation specialist to show your lender that by using this strategy, you are drastically increasing your cash flow by reducing your taxable income. Number 2, make sure that you're adding any value-add renovations to your basis and depreciation once you have these items completed. Third, if this is a new concept for you, you can look back to previous years and you don't have to amend your tax return to do this. Simply have your tax professional file a Form 3115, which changes the way you're planning to depreciate your already owned property. By taking bonus depreciation, number 4, on a property that qualifies as an opportunity zone, you can lower the adjusted basis of the property, decreasing the amount that you have to invest to meet the opportunity zone requirements, but it must match the cost with investment on opportunity zone deals. Cost segregation and bonus depreciation are complicated topics that all investors should educate themselves on. These 2 tools given to us by the IRS will not only help investors pay less in taxes and generate more cash flow, but it also has the potential to create generational wealth on a massive scale in a shorter amount of time. Now for my offer. Thanks for staying with me to the end of this video. I'd like to provide you with a quick, free analysis on any property that you own or are thinking about purchasing. I only need a few basic pieces of information on the property, and I can tell you what an engineering-based cost segregation study would cost you and how much it could potentially impact your taxes immediately. Again, thanks for watching. I'm hoping it was helpful to you. Again, I'm David Weiner with Cash Flow Strategies. After all, it's your money. Keep more of it.